Morgan Stanley has recently cut its 2020 MSCI Emerging Market earnings forecast and forward PE multiples, as it seems increasingly likely that MSCI Emerging Markets will be giving back all of its gains against developed market equities in the rally over the last 2 years. Jonathan Garner, Chief Asia and Emerging Market Equity Strategist at Morgan Stanley, is joining us to highlight just that. Jonathan, thanks very much for taking out the time and joining in. Let's start off with that question itself. Why do you think that the MSCI Emerging Market rally that we've seen over the last 2 years is going to come to an end and we're going to be giving it all back?
Well, if we look at the rally, it really peaked out as long ago as the end of January, and the MSCI EM index is down around 20% from the peak. So it's on the cusp of entering a bear market. And our new target price indicates, if we're correct, that it'll fall another 8% by June of next year. So that would make a peak to trough move of almost 30%. Now, we saw something larger than that as recently as 2015-16, and we saw something again around about 35% decline in 2011. So if you look at what caused those prior bear markets, we think we see something really quite similar today. So we see a significant slowdown in the global economy outside of the US, particularly in China and in North Asia. We see a decline in commodity prices, most notably copper, which always correlates well with EM on the downside. We are coming off very high valuations. So at the end of January, we were trading almost 14 times forward PE for EM, which is the 95th percentile of the long run range. So we have negative macro catalysts, a market that was quite overvalued. If we're right, earnings estimates are going to need to come down. They've already started to fall, but they have materially further to fall. And though this has been a bear trend since the end of January, it's only around 7 months old, and that's a little short to think that this is going to come to an end anytime soon.
Since you were talking about valuations for the Asia emerging market basket, for that matter, if you look at the 12-month forward price to earnings, India seems to be the most expensive and stretched out at this point in time, but that doesn't seem to be stopping the kind of rally that we've been seeing in the markets. Do you see that as a problem?
Well, we're overweight India, whereas, for example, we're underweight a market like Korea that's underperformed India substantially. I think the key point about India is that it's a very different stage of the business cycle from particularly the markets in North Asia. So India had an extremely weak economic environment really through the demonetization and GST reforms and then the fiscal tightening that was being done. Now you're getting a cyclical pickup. And that's allowing the market's earnings profile, I guess, to move forward. And whereas earnings expectations are coming down in other markets, particularly the more trade and global economic sensitive markets and sectors like autos and tech hardware across Asia, we're not seeing that in India. So we are actually able to recommend to clients consumer discretionary and capital goods stocks in India, which we're not recommending in the broader region. India is also not that exposed to global trade. It's somewhat exposed to oil and somewhat exposed to some of the developments that are going on in relation to sovereign risk elsewhere in the asset class. So we have had a couple of rate hikes in India. But our overall judgment is that India is a sufficiently strong macro and micro story now to justify an overweight. And as you say, it has outperformed.
Overall, from a foreign fund flow point of view, emerging markets and the emerging market Asia basket as a whole has been seeing thin flows over the recent past. Not too much in terms of the money allocation or the equity allocation is coming this way. Do you see that changing anytime soon?
Well, we track weekly all flows to and from emerging equity markets, and recently we have had some quite large outflows, totaling over $20 billion in the last, I guess, 3 months or so. However, prior to that, we had a period of very strong, near euphoric inflows that ended at the end of January when the market peaked. Now, only around 20% of the money that came in last year and the first month of this year has left as of now. And our judgment is both on the equity and the debt side, it's likely that the recent trend to outflows continues. And that's one of the reasons we think we have further downside in the markets here.
What do you think are the triggers that could probably see some of this money coming back into this basket? Because India, while we've been creating record highs on the indices, for us as well, the allocations are very thin, and we've been doing it on the back of what's been happening domestically. So the domestic flows are supporting this move.
Yes, indeed, that's right, and it's good that India has that domestic flows engine to support the market here. Well, I think typically flows to emerging markets are strong when the dollar is weak, but this year the dollar has been strengthening against most currencies. So I think that's one overarching issue. Then we have the path of Fed tightening. The Fed is tightening at a time when economic conditions in many other EM countries, or many EM countries, would indicate that they should be cutting rates. But what we're actually getting is a handful of countries are able to move their rates lower, China, for example, into their slowing economies. But some, Indonesia, I'd highlight in particular, has done 4 rate hikes this year. India's done a couple of preemptive hikes, but it hasn't been enough to derail its economic recovery story. So I think the interplay between the dollar, the Fed, the earnings cycle, where commodity prices are, and where the underlying trajectory of growth is outside the US, they're the kind of things that typically drive the cycles of emerging equities.
You know, you spoke about the strength in the dollar. You know, how far do you see that continuing? And the other aspects of the outlook for emerging markets, be that weaker economic data points coming out from China, pressure on emerging market currencies. You know, what's the outlook there, and where do you see that reversal coming in? Because the dollar strength seems to be unabated.
Yeah, so my base case is the dollar will continue to strengthen from here against emerging currencies, though it may weaken somewhat against the yen in a risk aversion trade. But we don't have enough of a real interest rate cushion for countries that are running significant current account deficits or have large amounts of external debt coming due to sort of withstand this adjustment that we're going through. So we are seeing an adjustment that's quite similar to the taper tantrum phase, and even has echoes of 97, 98. Now, one of the things that may turn this around is better growth from China itself. China is easing, but it's not yet obvious that that easing will gain traction. In particular, I'd highlight that consumer confidence is falling in China from a 20-year high. And so the consumer service economy that's been a big engine of recent growth in China is not performing as well as it was previously, certainly not as well as last year. So we tend to think it's going to be a tough environment for quite a while longer, and that's why we took our target prices down on Friday. And as I said right at the start of this interview, we see 8% downside to our June 19 target. That's quite material.
Let's talk a little bit more with regards to the trade tensions, Jonathan. I mean, we've got $34 billion worth of tariffs already, duties already imposed, 16 billion slated to go off on 23rd of August. I mean, there are talks of another $500 billion worth of goods and tariffs on that as well, 10% tariffs. What are the implications of that? And do you see major collateral damage across emerging markets?
So we've been writing about this all year, and it is a key risk factor. If you look at what's on the table now, the US is going through a public consultation process about an additional $200 billion, so that's live. The president, depending on that process, will make his decision in early September. So if it does go through, that would basically increase the amount of Chinese goods subject to tariffs from 50 to 250 billion, and that would be almost half of China's exports to the US. Bear in mind, though, as I say that a lot of those exports are actually coming from US multinationals. So this consultation process is throwing up a lot of issues from US multinationals who source from China. But it's probably the case that this is on the current trajectory likely to happen. And in terms of modeling the impact on global growth and Chinese growth, it's not overwhelming, but it would probably knock about 0.4 percentage points off our base case China growth number. And when you look at the broader impact by sector, it's really autos and IT that are challenged in any case by cyclical forces in terms of weak end-use demand that would be most impacted. So they're two sectors that we turned a lot more cautious on late last year. Again, they're cyclical sectors which we don't want to own in a falling market as well.
You know, just going by your report and the scenarios of the trade war and the escalation that happens and the incremental impact on global growth on China, if you could just highlight those numbers for us and give us the different scenarios and how it could impact global growth.
I think you're referring to our economist modeling of the global trade situation, is that correct?
Yes.
Yeah, so basically there's a status quo scenario where we stop at the 50 billion, and that would have a very marginal impact. Then the one that I just gave you is moving forward on the 200 billion, and then some areas which would also be impacted, including auto tariffs. And then we work through two additional more negative scenarios where we begin to get all countries putting tariff restrictions on each other. And some of those scenarios, particularly the most extreme one, are sufficient to really cause a material slowdown in global growth pretty well everywhere next year. And that's obviously the most adverse scenario.
The meeting to talk about these trade wars will happen in Washington this week. Do you think they'll find a common ground? What is the expectation?
I think that that's a relatively junior level meeting, and I don't think it'll lead to any likely significant outcome. I suspect that we are moving towards this more heightened trade tension, particularly in relation to the action that we talked about two questions ago in early September. I think this is an attempt to restart talks, but the senior level talks broke down 4 or 5 months ago, and I don't think there's any particular reason to see that this is going to lead to any breakthrough.
Jonathan, you mentioned commodities and especially copper, which has sort of entered into the bear market itself. We've been seeing, the commodity market putting sentimental pressure as well across emerging markets. What do you read into this?
Well, the copper price correlates very well with consumption and indeed investment spending within economies worldwide. That's why it's known as the metal with the PhD, Dr. Copper. It's always correlated very well with emerging equities performance, and we highlighted as long ago as last November that it was likely peaking out. It's been falling all year, but the last 2 weeks it's fallen at a faster rate. And that does suggest that one of the key points we've been making about the slowdown in growth outside of the US is absolutely validated with what we're seeing in commodity markets. So again, we would be very cautious on growth outside of the US when we look across at what copper's doing, and also the market with a PhD career that's full of early mid-cycle cyclicals is also doing very poorly.
Right. Jonathan, coming to what's been happening in Turkey and the pressure on the lira, which is causing a pressure on other emerging market currencies. For us here in India, we hit a record low for the rupee versus the dollar as well. And we have our own other internal pressures. The CAD was at a 5-year high. So, how are you reading into these smaller data points in the macro, setbacks for India?
Okay, so if we look at the Turkish situation, it's not a unique situation in the sense that it definitely has very high inflation compared to other countries, but other countries share the issue of current account deficit, and they also share the issue of relatively limited reserve coverage of external debt coming due. Turkey is the most significant there, but we pointed out that about 6% of market cap in EM has less than 1 year's reserve coverage of external debt coming due, and about 30% has less than 2 years, and that does include India. It doesn't mean that we're looking at any outright crisis situation, but I do think the RBI in India was very wise to do these preemptive rate hikes, because even with those preemptive rate hikes, we have actually seen the rupee, as you mentioned, weakening. If the RBI had not done those rate hikes, the rupee would have weakened more.
Just one last question from me, Jonathan. We've got the Jackson Hole Symposium now. What do you expect to hear from the Fed chief?
I don't think we'll hear anything of any great significance. It would be nice to hear about how they're thinking about the trade discussion, the trade disputes that we've touched on in this, but I think the Fed's thinking on that is at quite an early stage. I doubt very much that you're going to hear anything particularly market moving from that. Our base case is that the Fed does hike 2 more times this year at the September and December meetings.
All right, Jonathan Garner, thanks very much for joining, and really appreciate you taking your time out and speaking with us.
Thank you.